everyone, I'm Brooke Robbins. Welcome to this hour of the Orange County News Channel. We're now going to take a close-up look at the real estate market in Orange County. I recently talked with Gary Thomas about alternative types of home loans. We'll have that interview in a few minutes. But first, let's take a look at the Changing Hands Index. It'll show you how real estate around the county is selling. Our first home in Brea on Larchwood Drive, built in 1963, 4-bedroom. Pete Weitzner for a look at real estate news, and good news if you're trying to get a home loan. Mortgage rates are down, right, Pete?
They sure are, Brooke. They started to peak about mid-March, and then since then they have been trickling down. We had our second straight week on a national average of a pretty big drop. Let's show you the numbers. All across the board, 30-year fixed. These reported by Freddie Mac for an 80% loan-to-value mortgage. 30 fixed dropping 9 basis points, just about now the mid-level between the lows for the year and the highs. 15 fixed, which are now very competitive, dropping 8 basis points to 8.38%. And the adjustable rate mortgages also falling 11 basis points to 6.02%. The high on the ARMs was 6.22, so they are well below that. But you see how competitive those fixed rate mortgages are. Now, typically when people do refinance, and we had a spate of refinancings in the first few months, they've slowed down, but typically when people refinance, they do something other than an adjustable rate mortgage. By more than 90%, they do. The refinancings have slowed down, but when fixed rates stay this competitive, it is certainly tempting. John Lansner explains the quandary that confronts people with adjustable rate mortgage.
If you're having difficulty qualifying for a home loan, we have a few suggestions that may just help you out. I recently talked with Gary Thomas, a loan officer from First Federal Bank of California, who said alternative types of lending are available for many buyers. He also explained what to look for in an index when dealing with an adjustable rate mortgage.
We target the real estate agent because they have the best feel for the consumer's needs, because the buyers are going to the real estate agents, and the agents have hopefully a good lender they can refer that buyer to. But however, our bank is kind of now looking at the developer, the new developments that's been going on. So we're targeting a little more on the development side as far as the builder development. And the reason being is because they have a need for a good bank to help each borrower come in and qualify and make sure they close their loans on a timely basis. So between the real estate community, the real estate agents, and the developers, that's pretty much where we target, or I target, my business towards.
Yeah, because we were just doing an interview recently where an analyst in the industry was saying most of the homes being sold right now are the starter homes, the low-end homes, because a family can go in now and get a starter home for under $200,000, something that didn't happen in California very often.
Exactly. There are programs now designed for new development too, specifically.
So I would think those people would as well need a lower rate.
Yes, they do. There's rates in the 5s are not unheard of, even the 4s on an adjustable. And they're somewhat easy qualifying loans. When you're a portfolio bank, we have money set aside that we keep, portfolio. We keep it in our lending portfolio. So we're able to be a little more lenient than loans that are what they call sold on the secondary market. There are 2 types of requirements. So the portfolio lenders are more able to reach a lot more borrowers who are having difficulty qualifying for.
Since you brought it up, adjustable rate mortgages. I had one of those one time. Started out great, real low, and then at the end of the 3rd year, it went to whatever the rate was in the market at the time. And then in 5 years, it changed again, and that was horrible.
Right.
So adjustable rates sound great in the beginning, 4, 5, 6%, but they're not always the best thing for everybody, right?
You really have to examine the ARM. The adjustable rate mortgage nowadays is very protective. There are lifetime caps over 30 years of the loan, there are payment caps, and there are yearly interest rate caps. The key to an adjustable rate mortgage is the index, what causes that loan to go up and down. The 11th District Cost of Funds today is the most stable index. It's the cost of funds for the bank. There's the T-bill as an index. That's a little more volatile. There's the prime rate, which can start flying up and down depending on the economic conditions. So the index is very important. My recommendation is 11th District Cost of Funds for the stability.
Now, what is that? Now, why are you recommending that?
11th District Cost of 11th District Cost of Funds. The United States is divided into 12 districts, banking districts. The 11th District is California, Nevada, and I believe Arizona. So it's us over here. It's the cost of funds for the banks. It's an average. So if you looked at your CD account or your savings right now, you're probably getting about 4%. What it is it's an average of the savings accounts, the federal discount, the money that we borrow. It's the cost of funds for our bank. It's real stable. It doesn't fluctuate hardly at all. And right now it's on a downside. So whenever you choose an ARM, look at the index. Make sure you understand it. make sure you understand the whole mechanics of an ARM so that you're fully aware of what you're getting into.
That was Gary Thomas from First Federal Bank of California with some pretty good advice on obtaining the right type of home loan for your needs.